Hey everyone, it's Alex Morkate with Real Estate Shorts. Today we're going to explore cash-on-cash return. We're going to define what it is, how it's calculated, how it's applied, and what you can do to make sure that you're applying it in the right way. Let's get started. All right, so first things first, what is the cash-on-cash return? Cash-on-cash return is one of these cornerstone return metrics used in commercial real estate. It's defined as the cash flow that you receive in any given period relative to the amount of equity that you've contributed into that investment. More specifically, it is the cash flow, the operating cash flow that you collect in a given period relative to the cumulative amount of equity that you've contributed to an investment. And it's that last distinction that I think is really what may trip people up the most, but what also makes this unit of measure so valuable and important. And so we'll illustrate how that's the case and why it's important to you. So in this example, just to nail home the point of the original ratio, we have operating cash flow of $80,000 and equity contributed of $800,000. 80,000 divided by 800,000 gives us 10%. And so just like with many of the other ratios, as income changes or equity contribution changes, so will the result of this cash-on-cash return. Most investors these days are looking for something in the high single digits, but again, this is so variable and dependent on not only the investor, but the risk profile of the asset and the market. And so there's really no hard and fast rule of thumb of what is a good cash-on-cash return. It is wholly dependent on an investor's tolerance for risk, expectation of risk, cost of capital, what's going on in the marketplace at the time, and what they feel that property's overall risk profile is relative to their return requirements. So that disclaimer aside, I think it's probably best to aim for something in the high single digits and then begin to make adjustments thereafter. So let's dive into how it's calculated. So in this example, I think it's probably best if we start off summarizing some of the assumptions. So we have base rent of $30 per square foot per year on a 4,000 square foot space. Just to keep things easy, let's assume that there's no vacancy and it's a triple net lease, so there's no operating expense obligation for the owner. With that said, you can expect to collect $120,000 annually in income. So that would be the $30 times the 4,000 square feet. The next assumption is, what are you going to have to contribute for equity? So if you can purchase the property for $1.5 million, but you borrow it for $1 million, your equity requirement is the difference between the two, the $500,000. So we also have some loan information here so that we can help define what that debt service amount will be. So let's look at these cash flows through time. In year one, we have $120,000 worth of income, and we have $57,000, almost $300 worth of annual debt service. That's the amount based on the amount that we've borrowed relative to the loan terms, the 4% and 30-year amortization. For more details about how to calculate annual debt service, I'd recommend that you take a look at the mortgage payment video. So with here, we have the difference, the cash flow in that given year. So our income less our debt service of $62,000, almost $63,000. We had contributed $500,000 of equity. And so the ratio of the two, the cash on cash return, is almost 12.5%. So this would be $62,000 divided by the $500,000 worth of equity. Now let's see what happens the following year, because I think this really nails home the point of that cumulative concept of equity contributed. So we have the exact same income, $120,000. We have the exact same debt service, $57,300. However, let's assume that you have $100,000 roof repair or HVAC repair or some other major repair that happens in year two. Now, you could choose to pay for it all from equity. You could choose to borrow more. You could choose to pay for it all from cash flow. In this case, I'm going to choose the latter, and we're going to pay for it all from cash flow. And whatever is left if there's any left required, we'll pay for it from equity. So there are a lot of different ways to pay for these costs. Again, I would recommend you take a look at another video to illustrate and learn more about how you can finance some of these expenses. In this case, we're just going to assume it's split, some from available cash flow and some from your pocket. So let's see how this actually plays out. 120,000 less the 57,000 leaves you with 62,000 roughly. Now, if you had a $100,000 bill, you have a shortfall, so you'd also have to contribute equity. So in that year, you have a loss of almost 37,300 bucks. But where did that loss come from? You had to fund it, right? You had to fund that loss so you can pay for the roof repair. Where does it come from? Equity. And so if you'll notice, our equity contributed has increased. It went from 500,000 to $537,300, the additional amount necessary to fund the roof repair. So in this year, we have a negative cash on cash return. Why? Because we had the loss of 37,000 divided by the new cumulative amount invested. And then look what happens in year 3. Things return to normal, 120,000 in income, 57,300 in debt service, same $62,710 that we earned in year 1. These two amounts are the same. But look at what happens to cash on cash. It went down. Why? Because over the span of these 3 years, we had to contribute an additional $37,000. And so our return is lower. Although it's the same $62,000 worth of cash flow collected, it's relative to a larger amount of cumulative equity contributed. So the real benefit of cash on cash return is first that it includes leverage and it includes below the line items. However, it's also that it is a cumulative reference of equity. And so it'll show you how your potential contributions of equity through time will impact your returns. It's these 2 points that I think really distinguish cash on cash return from, let's say, some of the other return metrics like a cap rate. And I think what also really contributes a lot of its value in its application moving forward. So I think in just that vein, how is this applied? Many investors will come out into the marketplace and say they have both a cap rate requirement and a cash on cash requirement, so that they can make sure that at the acquisition stage or the development stage, they're confident that they can meet both the before debt and after debt return requirements, or top of line and below the line return requirements. This is also a great point of reference relative to the cost of capital, your leverage. And it's from here that I'll begin to introduce this topic of positive and negative leverage. So whenever cash on cash return is greater than your mortgage constant, you have positive leverage. When it's less than, you have negative leverage. So at this point, we're almost at a fork in the road. You can learn a lot more about mortgage constant and positive and negative leverage, or we can stay on the path of how cash on cash return is relative to those topics. I'm going to choose that latter path. So let's continue to just illustrate how this relationship is important to you. So assuming the same information we had before, what happens if we have this kind of deficit where cash on cash return is less than mortgage constant? If I borrow more, let's say I borrow 1.1 instead of $1 million, like most people would argue, that's a great thing. Let me come out and put in as little money as possible. But if the total return that you're earning on that equity is less than the real cost of borrowing, the more you borrow, the worse it is. So again, watch what happens. We're at 5.34% cash on cash return if we borrow $1 million. But if we borrow more, $1.1 million, our cash on cash return declines from 5.34 to 5.25. So again, I think the way you should interpret this is when cash-on-cash return is greater than mortgage constant, borrow as much as possible. You have positive leverage. However, when mortgage constant is greater than cash-on-cash return, borrowing may not work in your favor. So again, just to illustrate the point, let's say our cash-on-cash return is now greater than our mortgage constant. So the more I borrow, the higher our cash-on-cash return will be. So it goes from 6.18 at $1.1 million borrowed to 6.45 at $1.2 million borrowed. So I hope that this rounds out the topic of how cash-on-cash return is important as a relative unit of measure to mortgage constant, as well as on its own, to help you distinguish between cap rate and other unlevered or untime-oriented units of measure. So just as a recap, we covered what cash-on-cash return is, how it's calculated, how it's applied, and we're beginning to introduce its relationship to the cost of capital, positive and negative leverage. So if you found this video helpful, I'd recommend you take a look at a handful of others. And as always, if you have any questions, comments, or feedback, I look forward to hearing from you. Talk to you soon.